Hello, my friends. Brett Pattison here with Iron Gate Global Advisors, coming at you from the financial capital of the West. That, my friends, is Salt Lake City, Utah. With this month's market commentary video, we will address fear, because fear has taken over the market, but we're going to address it in a different way and discuss why you should be optimistic. We'll give you 3 ideas as to how we are approaching the current market. And we'll start out with looking at January. January, you can see this big picture of a bear. That is what is on people's minds. The big bad bear. 2008 is coming up in their memory, in which a lot of people were scarred. And in fact, fear right now, this is the CNN Money Fear and Greed Index. It is at an extreme fear rating. In fact, some people that measure this type of thing say it's the same type of fear that we saw in 2008 when the world was collapsing. There's a lot of doom and gloom. A lot of doom and gloom from the media, from marketers trying to sell you products, telling you that things are happening in order to sell something. This fear is being driven by a lot of people. But here's our view. And here's our thoughts. Instead of being afraid of a bear, we want you to embrace it. We want you to give that bear a high five. We'll tell you why we believe that is the way you should be approaching it. Again, give you some ideas, but let's start with January. Let's take a look at January and what happened. Here you have just a little chart that shows you the S&P 500, the developed non-U.S. markets, think Asia, think Europe, emerging markets, think China, think India. And then in brown is the all-world country index that tracks all of the globe, all the 3 areas of the globe mentioned above. And you can see there in the chart that it wasn't good. It wasn't a great month. You know, we're down a little over 5% in the U.S., down worse in in other parts of the globe. So it was the worst start to a year in market history. Certain sectors, as we look at sectors in January, were hammered. Consumer staples and utilities were higher because they're more defensive in nature. But you look at some of the financials, just hammered across the board. The average S&P stock was down around 25%. Now, the S&P wasn't because of the way that it's market cap weighted, but the average S&P stock is down 25% from the highs that the market reached a few months ago. That's crazy. So why do we love the bear? Why do we embrace the bear? And I want you to think of 2008. Think of what you would do differently based upon your experience in 2008. The biggest thing you have to have is discipline. And the markets have always rewarded discipline. Here's a chart on your screen here of 1970 through 2013, the all-world country index. And you can see all these terrible things that happen. You have Business Week, the death of equities. You have income tax rates increase. You have the terrorist attacks. You have the 2008 just horrible market. But yet the chart goes from lower left to upper right. The market is for the most part not always heading higher, right? There's given years that it doesn't, but for the most part it heads higher because companies continue to improve and increase earnings. That discipline is what you need to have in mind. And let me address this a little bit more. You see, here's the problem. I'll bring up a good thing and then I'll bring up the problem. The good thing is in 2014, and hopefully all of you took advantage of this, the S&P 500 returned 13.7%. That's great. But here's the problem. If you would have missed the best 10 days that year, your return would have been minus 3.1%. In only 10 days. The market in 2014 had moments where it fell 5.5%. It fell 4.5%. Towards the end of the year, it fell 10%, about what we've experienced now. But yet, it rebounded quickly and returned positive 13.7%. Now, I'm not saying that 2016 is going to be a repeat of 2014. All I'm trying to point out is that the problem that people have is that when the market falls 5% and 10%, they freak out and they sell at the exact wrong time. Here's the proof. These are statistics over 20 years that show the average investor, meaning those people that manage their own money, versus REITs to bonds to you can see highlighted the S&P 500. The S&P 500 in that time frame was roughly up, upper 9%. The average investor, clear on the right-hand side, because of the psychology, because they're not hardwired to embrace those 10% pullbacks, they're just over 2%. That's the problem. People buy and sell at the wrong time because of those emotions. In this, you have to understand risk. There's two components to risk. There's volatility, which is not risk. Anybody that tells you volatility is risk is wrong. Volatility is the price you pay for reward. Volatility can be down. Volatility can be up. Volatility is not risk. That's what we're experiencing right now, volatility. A lot of negative volatility. We think too negative based upon current economic conditions, but a lot of negative volatility. Now, here's the thing. Risk is the permanent loss of capital. That's how Howard Marks describes it, the permanent loss of capital. So if you look at that and you say, okay, well, I know if I invest and I need return, right? I need to make money on my money to be able to retire. Well, then you're going to have to deal with volatility. The risk is when you freak out because one of your favorite companies is down 25%, and so you sell only to see that stock rally the next month and make up half of that loss, if not more. That's where the risk comes in. So there's three things that we are doing in our client portfolios. These are not recommendations. It's simply our playbook for current market conditions. And it's the reason why you should be so optimistic about the market right now. And the first thing is, in that playbook, is you are able to accumulate great assets at cheap prices. Those could be businesses. We call stocks businesses because you're not investing in a stock, you're investing in a business, right? It could be great businesses that are trading very, very cheap. It could be fixed income opportunities. Those that attended our client lunch at Roost Chris in Salt Lake know that we are looking at that fixed income world with one of our friends, Andrew Kennedy. If you want more information on fixed income opportunities, let me know. I'm more than happy to talk about it with you. There's also opportunities in alternative investments as well, right? So you look for these great assets that have just been thrown out because of fear, and you look to accumulate them. That's the first thing, which we certainly are doing. The second thing is what we do, which a lot of people don't do, is we utilize options. We utilize options for income purposes and one other purpose, which I'll mention. But we are selling covered calls for income on those stocks that are sideways to down. We're generating profits each month by selling these covered calls. And I want you to think about this for a second. If we can generate extra income, then we can reinvest that income in that number one bullet point, in those assets that are on sell. And if we can reinvest that income that we're generating simply by selling covered calls, then we can compound our returns quicker. That should make you excited, right? The other thing that we're doing to compound returns, hopefully quicker, no guarantees in this world, but we're using options for protection as well. When I say options for protection, we can reduce volatility in a portfolio by 20 to 30%, and we are for some clients. Those strategies include long puts on certain areas of the market. We're short certain areas of the market that we feel are very weak and in a bubble type situation. And those long puts have been working, knock on wood, right? No guarantees. And there are risks to any strategy that you apply. But if we can make money in certain areas of the market by being short those areas, that's going to be an advantage. And we utilize what's called spread trading. If you're not familiar with it, it's just a long put vertical that makes money as the market falls. So we can utilize a portion of clients' assets to short areas of the market or the market itself to reduce volatility and, again, to create extra profits. If we're short and it works out and we close out a trade, knowing that the market is ultimately going to end up going back up, and we can reinvest into, once again, those assets that we love, then your ability to compound returns increases. Again, no guarantees, but that is the playbook that we have in front of us. Last piece of advice from us at Iron Gate Global. We would say we will not let a 5-day or 5-month bear market or a 12-month bear market destroy a 5 or 10 or 30-year plan. You've got to be disciplined. The markets have always rewarded discipline. You've got to be disciplined. If you want more information, jump on our website, www.igga.com. We feel like the current market conditions are truly going to separate us from other people that manage money and from other investors because of our discipline, because of that playbook. You may not see those results immediately, but over the course of 2, 3, 4, 5 years, they will show themselves. And that makes me excited, right? Jump on our blog, on our website, again, IGGA.com. Check out some of our articles, which will help you navigate through this volatility. Again, if there's any questions, feel free to email me, brett@igga.com. Give me a call. Follow me on Twitter. There's a lot of thoughts that I share on Twitter as well. We'd love to hear from you. Thanks, my friends. Until next month.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.